Well, I want to start by thanking Jayati and Chandru for bringing us together in this beautiful campus and getting to know people I don't know, and mostly for putting these issues on the table. I mean, debt and climate. Somehow, we don't talk about them at the same time sufficiently. They are probably the most important couple to put together. And so I feel this is a very creative discussion. These are issues we need to bang on the head. There are lots of ideas, and it's going to take more discussion. It's probably the first meeting I go to where we discuss these two things together seriously. I've been discussing lots of these issues, but in a very separate tables. And so much so that, when you invite leaders from the South to various fora, the Paris Forum, the spring meeting, they're getting increasingly angry because these tables are so separate. On the one hand, we promise them trillions in the future, sometime far out. And on the other hand, the house is burning today. And, very few tables put that together. This is a paradox of the time, really. And so, I want to try to speak a little bit like Kevin and Marina or Avinash, trying to bring those together, but I want to try to broaden a little bit the frame in terms of the various possibilities of how to break this paradox. So just to put on the table the figures we're all talking about, Stern, Nick Stern and company came up with the trillions. This is the table they put together in the latest triple agenda report. $1 trillion external finance is part of a $3 trillion, I think, additional, of which $1 trillion is external finance by 2030, and by 2050 it will be much more, but that's the first goal. And they divided between LICs, LMICs, UMICs, ODA, private flows, 500 billion each. So we can talk about the details, but just let's focus on these big numbers. These are additional, and try to ask, Nick Stern tells us this is what we need. This is not a political number, but let's try to ask how realistic is it, what it would take, where are the pressure points and the like. So that's what I want to try to do. So to put things in perspective, these are the flows today to LICs, LMICs, and UMICs, excluding China. So what do we see? We see FDI up there, remittances, number one, workers abroad. This is what's really financing development. But capital also, FDI is up there around $300 billion. I imagine a lot of it goes to oil and dirty stuff. So a big challenge is we need to go to 500 billion in private extra, so in addition to that. You see private loans also being quite high. Private loans have gone up and down. They go up when there's lots of liquidity in the market. These are a lot of bonds. So mostly after the global crisis, and then during HIPICs, you see they're peaking out. It's coming down now. And so what do we do? It's coming down. Jayati say, withdraw from the system, kill the debt. Kevin also wants, with Marina, want to reduce the debt. Some countries think that it may come back. So this is going to be a big issue. And then bilateral IFIs are below. It's quite smaller. Yet, when we look at the ambitions, a lot of the more concrete ambitions are tripling the IFI, scaling up the World Bank and the other development banks. This is where the action is right now. So tripling from 150 to 500 in ODA extra, in addition to the 150 that's going on. Now, the IFI, Jayati, have been counter-cyclical in this graph to some extent, right? They did scale up. They did scale up, from where they are, from 100 to 150 during COVID. But you're totally right that a lot of their lending, exactly, a lot of their lending at flexible rate and with the rising interest rate The lending is not down, but net transfers are down because repayments are much, much higher. Even though they give countries the option to put these loans on a fixed rate, but very few countries take that option. So, China, as you see, is below, in spite of all the talk about China rising and the like in the big picture. It's a little bit like the private sector. It moves up and down, and for some group of countries, for the LICs and the LMICs, it's more apparent. So we have two waves coming down. And so we see, clearly the challenge is to move first with the MDBs, try to shift FDI to green, and to see what to do with this private loan. Is the wave over, and can we replace these bondholders by a new class of creditors? These are some of the challenges. But the first move is with the MDBs, and the problem with the IFIs, if you like, is the negative net transfers that people have talked about. Sorry, lots of data here, but I thought it was important. Long-term net transfers to LICs and LMICs went down from 84 billion to minus 15 billion, and worse in 2023, maybe minus 60. I don't know where you get your figures, but that's the broad estimates. But at the same time, we have IFIs actually move up to 68 billion, close to 70 in the year of COVID, and still quite high at 32, with bilaterals coming up as well. But all this money coming in, as Jayati showed us, is moving out to the private sector right now. So you see the private sector moving from plus 50 to minus 50, a huge swing, and China a small swing. Even though they're much more bad-mouthing about China than the market, it's the market that's the problem right here. So aid effectiveness is really down. Whatever the IFIs are putting in is going out. In that context, scaling out is really a problematic proposition, scaling up. Even the IDA replenishment is problematic. Not only budgets are tight, but donors can realize that this money is actually bailing out private creditors and not sticking in the countries to finance investments. So there are three possible solutions here. And one is to continue doing what we're doing. Perhaps this is what Avinash proposed, that if this safety net, if you like, is big enough, then it would reduce the cycle. And if the commitment to refinance is high enough, the private sector will stop withdrawing money. That's one possibility. Or maybe it will continue to withdraw. So basically, it will be quite expensive to finance countries because you need to bail out their creditors at the same time. That's one option. The other option is the option that Kevin and Marina put on the table. Let's take a moment now. Let's reduce those debts, the private debts, clean up the slate, and then we will scale up IFI lending. That's another possible solution. And the third possible solution is the one we're proposing, which is reschedule that debt for now. Most of it is for countries that are not yet insolvent. Push it out so that we can see if we can get better. So let me speak a few minutes about each, and that's all I have to say today. It's a short talk. Refinancing. Refinancing is probably too costly. This is the debt service due not by all the countries, but by those that we consider to be illiquid. There are about, in our estimates, like in Kevin Marina, about 15, 18 countries now insolvent. They need that reduction. Those need to go to the common framework. But we estimate there are about 40 countries here out of the 66 that are illiquid. And this is the debt service that is due. As you can see, there are walls. They are solvent but illiquid because they borrowed from the market relatively short term and from China as well to finance long-term infrastructure. And so, given that they started borrowing after the global crisis, this is when the bullet payments are coming due. There are walls. But given that net transfers, as you saw, are close to zero, they're not massively negative. They're not repaying those walls. They are borrowing short-term from banks, and so those walls are moving. Now, those walls could be repaid by the IFIs. They just refinance them. But we're talking about something like $40 billion a year, which for this group of countries involves doubling IFI transfers just to refinance those walls outside of the tripling agenda. So it would mean instead of tripling, we need to multiply by 5 if we go that route. So it's a very costly one. And basically what would be ideal is to try to shift over time from these creditors to creditors that have longer term horizon. So I'll come back to that a little bit later. The second solution is the big debt reduction. It's let's take a moment, let's reduce debts massively, and then we would refinance on a clean slate. There are several problems with this. I mean, of course, it will be ideal. The first question is it feasible? I mean, already we see countries that are over-indebted having difficulties in their debt reduction, Zambia and others. Now we're proposing to go and to the private and Chinese creditors and say, listen, these countries are not yet insolvent, but they will be insolvent in 5 years if all the promised money comes in. Therefore, give a debt reduction today to create headrooms for others. It's a tough proposition. I don't know if it will be very successful. As you can see, this is the debts of these countries. It's about 25% of GDP on average, of course, with some variability. Some are higher. These are various scenarios. So with the red negative scenarios, these debts grow. These are all IMF optimistic scenarios, so things are likely to be worse. But still, there is room. I mean, this is not HIPIC. HIPIC time debts were twice, if not more, higher. And moreover, while you could argue that you cannot grow out of this debt, you can equally argue that you can grow out of this debt. And so the argument is hard to make. It depends entirely on how much primary surplus and growth you have. These are graphs by Homi Karas about various scenarios of what he calls the big push strategy. So big push strategy, we're going to triple IFI, we're going to invest a lot in green growth, in adaptation, and we're going to reduce the drag on the economy, the growth rate will go up. The question is, growth will go up, but does it go up so much more than debt that creditworthiness improves as well? Well, it depends on the growth rate, on the interest rate, on the primary surplus, like Kevin and Marina paper showed, but it depends entirely on those. So in the upper right scenario of high growth, high primary surplus, you see the red dots represent the debt ratios. They go down, and so you improve your creditworthiness with a big push, while on the bottom left, low growth, low primary surplus, the debt actually goes up. So, there's a lot of uncertainty about where will we be by 2030 and 2050. And so it's a little bit hard to imagine that let's take a decade to reduce debts today kind of strategy will work, even though it sounds attractive for civil society groups. So it's okay to militate for it. But if we're realistic, we might think of this solution as being somewhat more likely. That is rescheduling. How come we don't talk about rescheduling anymore? The Baker Plan was a great plan, but was the wrong plan for Latin America. But a Baker-like plan may be a good plan today for, say, countries like Africa, because unlike the 80s, we're not talking of shifting to a completely different growth strategy, from public sector led to market. Now you have markets, you have domestic markets. It's a big shock to the economy. It's monetary policy in the West that is the problem. Now, it could last for a few years. Real interest rate can remain high. This wave that we've seen may not come back up in 2-3 years. Actually, you may think that this market is kind of going to die slowly because we won't have these huge expansion with zero interest rate for any time soon. There'd be more spending on health, on military, on climate, and real interest rate will be positive. And so we need time, and so let's reschedule these debts, say over 5 years, during which the big push hopefully start happening, World Bank, IMF, others working together, tripling their agenda, getting green growth going, and hope that by then we can progressively shift from this existing class of bonds to green bonds, to other holders, that are socially more responsible, have shareholders that are more responsible, to figuring out what is blended finance, new FDI that comes to be invested not in adaptation but in mitigation, while new debts and grants by the IFIs go into adaptation. So in the meanwhile, we push the debt service out. So that would be the solution we have proposed. So just to conclude, there is, if you look, we need an extra trillion of flows. Right now there are about 3 trillions of debt stock. So we need a trillion flow, and we have 3 trillions of stock. So you can see the immensity of the ambition. It's very ambitious. It's starting with the IFIs. Now, if we start with the IFI leaking out completely to repay that dying wave of debt, we're going to lose a decade easily. And the private sector side is equally challenging. We don't have solutions. And so our proposal is, as I said earlier, let's try to focus on rescheduling for now. What does it mean concretely? It means doing a little bit like Kenya did, but much better. I mean, what did Kenya do? They got massive support by the IMF, 5 times quota or 6 times quota, by the World Bank. They committed $10 billion for 3 years. There's no real program yet, so the national program was put together very quickly because Kenya is the poster child and everybody wanted to help them. And then they went to the market, and the market, did respond somewhat, but lent at 10.5%. So it didn't take very seriously these growth projection. This whole thing could be improved. You have to start with a serious national program, an ambitious national program of green recovery and adaptation and green growth over 5 years. We need financial commitments by the international organization, not just ideas, commitments. And then you need to reschedule or roll over the debt. If the market comes down, great. And if it doesn't come down, somehow you have to talk it down so that these interest rates are realistic. Because at interest rates that are not realistic, like the red line even here, you would see that you cannot pass over the hump. They need to be realistic. Thank you.